People love to complain about taxes. They curse at the government. They blame politicians. They say life is unfair. But here's the uncomfortable truth. Most people don't lose money because the tax system is evil. They lose money because they never bothered to understand the rules. And in my experience, ignorance is always more expensive than any tax rate. Taxes are one of life's certainties, but the amount you pay is not. It never was. The idea that taxes are a fixed bill is one of the biggest illusions in personal finance. People talk about taxes as if they're some divine punishment that can't be questioned, like gravity or aging or your knee hurting when you hit 80. But taxes are not physics. Taxes are man-made. They're rules written by lawyers, rules full of incentives, rules full of odd exceptions, rules full of opportunities for anyone willing to read more than 3 sentences. The wealthy understand this. The average person does not. And that gap in understanding is where most of the money disappears. Now, before I go any further, let me tell you something that might surprise you. Warren and I are happy to pay taxes. We believe it's our duty as citizens who have benefited enormously from the American system. The roads we use, the courts that enforce our contracts, the educated workforce that runs our businesses, the military that protects our assets, all of that was built with tax dollars. Warren has said publicly many times that he should pay more taxes. He's pointed out that his secretary pays a higher tax rate than he does, and he thinks that's wrong, not because he's being charitable, because he understands arithmetic and fairness. Bill Gates has said the same thing. He believes wealthy people should contribute more to the society that enabled their success. Elon Musk paid $11 billion in taxes in a single year, more than any American in history. When people complained he wasn't paying enough, he simply showed the receipts. Here's what people don't understand. The wealthy don't hate taxes. They hate waste. They hate inefficiency. They hate paying more than the law requires because someone was too lazy to read the rules. There's a difference between tax optimization and tax evasion. Evasion is illegal and stupid. Optimization is legal and smart. The wealthy do the second, and they do it while still contributing billions to the public treasury. I'm not talking about doing anything illegal. I'm talking about using the system exactly as it was designed. The government wants certain behaviors. They want people to invest. They want people to build houses. They want people to start businesses. They want people to save for retirement. So what do? They reward those behaviors with tax advantages. Generous ones, shockingly generous ones. But here's the funny part. Most people never take them. They don't know they exist. Or worse, they think they're tricks for rich people. They're not tricks. They're tools. Tools available to anyone who's willing to plan ahead instead of stumbling through life like a drunk sailor. Let me tell you something simple. People who complain about taxes tend to be the same people who never plan for them. They only think about taxes once a year, usually the night before filing, and they expect to win a game they never practiced. Imagine playing bridge like that, or poker, or golf. You'd get crushed. It's the same with taxes. You can't play well if you never look at the rules. The wealthy treat taxes like an ongoing strategy, not an annual chore, a strategy. They know taxes will likely be the single largest expense of their lives, bigger than food, bigger than housing, bigger than healthcare. So they do the rational thing. They optimize it. You'd think that idea is obvious. It isn't. Most people spend more time comparing prices at the supermarket than thinking about their lifetime tax burden. They'll drive across town to save $2 on a gallon of milk, but they won't spend 30 minutes learning how to save thousands on capital gains. People love small savings because they're easy. They ignore big savings because they require thought. But in life, the big money is always in the big decisions. Here's something else you should know. The tax code isn't a moral statement. It isn't trying to punish you or reward you. It simply reflects incentives. You get tax benefits for owning a home. You get tax benefits for investing long term. You get tax benefits for providing housing to others. You get tax benefits for starting a business. You get tax benefits for building wealth instead of consuming every dollar you earn. Isn't that interesting? The behaviors that build financial security are the same behaviors that receive the best tax treatment. In other words, the tax code is basically telling you, if you behave rationally, you win. But rational behavior isn't common, and that's why these tax advantages end up benefiting the minority who actually pay attention. Let me be blunt here. If you ignore taxes, you're volunteering to be poor. You're handing money to people who understand the system better than you do, and they will take it happily. One of the greatest financial advantages of my life came from simply not being stupid. I avoided the dumb mistakes that everyone else made. And one of the dumbest mistakes you can make is failing to consider the tax consequences of your actions. Before I buy anything, I think about taxes. Before I sell anything, I think about taxes. Before I structure anything, negotiate anything, or sign anything, I think about taxes. It's not paranoia, it's rationality. Because taxes, unlike the stock market, are predictable. You know the rules. You know the consequences. There's no excuse for ignoring them. People ask me how to get rich. I tell them the same thing. Avoid stupidity. Avoid unnecessary losses. Avoid letting the government take more than it's legally entitled to. That alone will put you ahead of 90% of the population. Taxes are not the enemy. Ignorance is. And if you eliminate ignorance even a little, you'll be shocked at how much money stays in your pocket. The rich understand this. That's why they stay rich. The rest keep playing a game they never bothered to learn, and they wonder why they keep losing. Most people buy a house because someone told them it's the American dream, or because their parents said renting is throwing money away, or because a real estate agent promised them they'd build equity. All of that may or may not be true. But I'll tell you the real reason the primary residence is valuable. The reason the wealthy treat it like a strategic weapon instead of a sentimental purchase. It gives you one of the most generous tax breaks ever written into law, and almost no one uses it intelligently. Let me explain something simple. When you sell almost any asset, stocks, land, businesses, you pay capital gains tax on the profit. That's the deal. You make money, the government wants a slice. But your primary residence is different, very different. If you're single, the IRS lets you keep the first $250,000 of profit tax-free. If you're married filing jointly, it's $500,000. You don't owe a penny in capital gains tax on that amount. Not one. Do you know how generous that is? It's absurd. It's practically a gift wrapped in legal paperwork. And the only real requirement is to live in the home for 2 years. 2 years. That's it. You don't need to be a genius. You don't need to be wealthy. You don't need to hire an army of accountants. You just need to know the rule exists. Most people don't. Here's where things get interesting. Imagine adding $500,000 to your net worth without paying any tax. Do it twice and you're a millionaire, even if you never invest in anything complicated. And yet the average person lives in one house for 20 or 30 years, pays interest, pays maintenance, pays insurance, and never once considers how to optimize the tax side of ownership. They treat their house like a museum, something to sit in, something to decorate, something to emotionally attach to. The wealthy treat it like a movable financial instrument. You see the difference? People ask me, Charlie, isn't this taking advantage of the system? No, this is the system. The government created the exclusion on purpose. They want people to buy homes. They want stable neighborhoods. They want families to build wealth. So they reward the behavior that produces those outcomes. The people who could benefit the most from this exclusion, middle-class families, are often the ones who ignore it completely. They buy once, they stay forever. They let the tax break gather dust. That's what I call an unforced error. a loss caused by inertia, not misfortune. Before you buy a home, ask yourself a simple question. Am I using this asset the way the tax code intends me to? If the answer is no, you're leaving free money on the table. One last thing. People love to say, the rich get all the tax breaks. No, the rich use all the tax breaks. The breaks were there for everyone. The rich simply bothered to look. The tax exclusion for a primary residence is not a loophole. It's not a trick. It's not a secret. It's a law, a very generous law. And if you ignore it, the only person to blame is the one in the mirror. People love to complicate investing. They chase exotic strategies. They gamble on things they don't understand. They day trade like they're auditioning for a job at a hedge fund. Most of them lose money, of course. And yet the simplest, most reliable tool for building long-term tax-efficient wealth has been sitting right in front of them for decades. It's called the Roth IRA, and it's one of the rare cases where the government actually rewards you for being prudent. Let me explain this in the most unromantic way possible. With a Roth IRA, you pay taxes up front. Money goes in already taxed. But everything that grows inside the account, every dividend, every capital gain, every compounded dollar, comes out tax-free. Read that again. Tax-free. This is not a gimmick. It's not a coupon. It's one of the few deals in life where the government steps aside and says, fine, keep it. If you think that's insignificant, you haven't done the math. Most people underestimate the brutality of taxes on long-term wealth. Let's say you invest for 40 years. Every time you sell, every dividend, every rebalance, every withdrawal, you lose a slice to taxes. And like anything else in life, small bites become big chunks over decades. With a Roth IRA, none of that happens. Compounding is allowed to do its job without interference. And compounding without interference is a superpower. But here's the strange part. Most people ignore it. They say, well, I don't get a tax deduction this year. And then they pat themselves on the back for being financially responsible. This is the kind of small thinking that keeps people mediocre. They trade a little benefit today for a massive benefit later, simply because the later benefit requires patience. Let me give you a principle that has served me well for almost a century. The world rewards long-term thinkers and punishes short-term ones. The Roth IRA is designed for the long-term thinker. It's literally a bet on your future tax burden. And here's the irony most people miss. If you expect your income in retirement to be high, then a Roth IRA is a no-brainer. Most retirement accounts, traditional IRAs and 401ks, delay the tax bill. They don't remove it. They simply shift it. And when you retire with a large portfolio, the IRS will want a bigger share. With a Roth IRA, that problem never arrives. Not at 60, not at 70, not at 90. In fact, the government doesn't even force you to take money out. There are no required minimum distributions. You can let the account grow for as long as you want. You can pass it to your heirs. It's one of the cleanest vehicles for transferring wealth tax-free. Most people have no strategy for taxes in retirement. None. They simply hope they'll pay less because they'll live on less. That's wishful thinking disguised as planning. If you invest well, you'll have more income in retirement than you expect, and the government will tax it more than you prefer. This is not complicated. It's predictable. A Roth IRA is the cheapest insurance policy against high future tax rates you'll ever get. Yet the average person contributes nothing. Zero. They say they can't afford it, but they can afford new phones, new subscriptions, new distractions. You can always afford your priorities. You just can't afford your excuses. Here's a rule I live by at Berkshire. Boring wealth beats exciting poverty. Most people choose the second option. They don't do it intentionally. They drift into it. They chase shiny objects. They skip the basics. They avoid the unglamorous work. And then 30 years later, they wonder why their retirement depends on Social Security instead of their portfolio. If you want to avoid that fate, you don't need brilliance. You need consistency. You need patience. You need a Roth IRA and the discipline to fund it every year. The government designed the Roth IRA to reward those who think ahead. Take the hint. If you want to understand why wealthy people love real estate, don't start with rent checks. Don't start with appreciation. Don't even start with leverage. Start with taxes. Real estate isn't attractive because it's glamorous. It's attractive because the tax code treats it with a level of generosity that borders on comical. Let's begin with the strangest part. When you own a rental property, the IRS allows you to claim that your building is wearing out over 27 and a half years. That's called depreciation. Now, here's the funny part. The building might actually be gaining value. The neighborhood improves. Inflation lifts replacement costs. Demand increases. But the IRS still lets you pretend it's deteriorating, like an old shoe falling apart in slow motion. And that illusion, this polite fiction, is worth a fortune. Suppose your rental building is worth $500,000, divided by 27 and a half years. That's roughly $18,000 in depreciation deductions per year. Let me translate that. You get to reduce your taxable rental income by $18,000 for a building that very likely isn't falling apart at all. This is why I sometimes say the tax code was written by people with a strange sense of humor. They reward you for an expense you never actually paid. And depreciation is just the opening act. Almost every cost associated with a rental property is tax deductible. Property taxes, insurance, repairs, pest control, landscaping, management fees, legal fees, and of course, mortgage interest, often the biggest piece. By the time you add up all these deductions plus depreciation, your taxable rental income can easily fall to zero. Zero. Not because the property didn't make money, but because the tax code allows you to calculate income in a way that favors you. This is one of the rare moments in life when the system is rigged in your favor. Naturally, most people never take advantage of it. They say real estate is too much work, or too risky, or too intimidating. Fine. But don't complain later when you see landlords paying far less tax than employees. It wasn't trickery. It was competence. Now, let me tell you the part that separates amateurs from professionals. Depreciation isn't entirely free. If you sell the property, the IRS may want some of it back. That's called depreciation recapture. Most people don't realize this. They think depreciation is pure profit. It isn't. But here's where the intelligent investor outmaneuvers the taxman. You can avoid recapture by doing a 1031 exchange, a perfectly legal mechanism that lets you roll your gains into a new property without paying taxes. You're deferring the tax into the future. And the future is where clever people like to move unpleasant things. Remember what I said earlier. The rich don't evade taxes. They postpone them for so long that occasionally they never pay them at all. If you hold real estate until you die, your heirs receive it with a stepped-up basis, meaning all your lifetime gains vanish for tax purposes. You enjoyed rental income for decades. You enjoyed depreciation deductions. You enjoyed leverage. And then you exited the game tax-free. That's why wealthy families don't just own real estate. They keep real estate. You'll notice something about all this. Nothing here is secret. Nothing is hidden. The tax code openly encourages property ownership. Why? Because society needs housing. And the government would rather incentivize private investors than run apartment buildings themselves. So the incentives are enormous. Yet the average person focuses on tenants, repairs, clogged toilets. They obsess over inconveniences. They ignore the mathematics. The wealthy think in systems. They think in rules. They think in cash flows. They don't look at a rental property and see headaches. They look at it and see predictable income, tax-deferred growth, tax-reduced earnings, tax-free refinancing, and tax-free transfers at death. You tell me, which is more important? A broken faucet or 40 years of compounding after taxes? If you really want to understand why some people accumulate wealth effortlessly while others struggle for decades, start by examining one simple difference. Employees pay taxes first. Business owners pay taxes last. That one distinction explains a tremendous amount of financial inequality in the real world. Most people don't realize this. They think the rich must be doing something scandalous, some conspiracy, some backroom deal. No. What the wealthy understand is embarrassingly simple. They understand sequence. Employees follow this sequence. Earn, then tax, then spend. Business owners follow this sequence. Earn, then spend on legitimate business costs. Then tax on what's left. That reversal changes everything. When an employee earns $1, they might only keep 60 cents, sometimes 50, sometimes less, before they buy groceries, before they pay rent, before they drive to work in the first place. The government takes its cut instantly, but the business owner earns $1 and gets to spend that dollar on the things required to operate their business, often things they would have paid for anyway if they were employees. A car, a computer, a phone, internet, software, travel, training, a portion of their home office, meals related to work, professional services, equipment, tools, marketing, insurance, hiring help, all legitimate business expenses, all deductible, all reducing taxable income. The employee and the business owner might drive the same car, use the same laptop, drink the same coffee. Only one of them gets to deduct those costs. And people wonder why business owners end up with more money. It's not magic. It's structure. The tax code doesn't favor the rich. It favors productive activity, risk-taking, value creation, entrepreneurship, job creation. The system rewards the people who create the economic engine, not the ones who merely operate inside it. And before someone gets offended, let me clarify. There is nothing morally wrong with being an employee, but there is something financially dangerous about staying blind to the rules that govern your financial life. Employees often think the game is fair. It isn't. But it's not unfair because someone cheated. It's unfair because someone else read the rule book. People come to me asking how to pay less tax. They want a trick, a shortcut, a loophole. I tell them the truth. You want lower taxes, start a business. The tax code already gave you the answer. They usually don't like that. It sounds like work, responsibility, risk. Of course it does. That's why the rewards exist. If starting a business required no effort or courage, the tax benefits wouldn't be there. But even a simple side business, legitimate and modest, opens financial doors that a regular W-2 job never will. The moment you become a business owner, even in a small way, you move from a system designed to take taxes from you to a system designed to let you control when and how you pay them. Now, before someone misinterprets this as encouragement to commit fraud, don't. Cheating the IRS is stupidity of the highest order. Everything I'm describing is legal, simple, and explicitly supported by tax law. If you don't understand how to use these rules, hire someone who does. A CPA is not a luxury for the wealthy. It is the toll you pay for not wanting to be financially incompetent. There's a pattern you notice after you've lived a long time and watched how wealth behaves across generations. The rich don't play the same game as everyone else. And the biggest difference isn't intelligence. It isn't luck. It isn't even work ethic. It's structure. The wealthy arrange their financial lives in ways that minimize taxes legally, maximize compounding effortlessly, and preserve assets indefinitely. If you want the cleanest example of this, look at the strategy people now like to call buy, borrow, die. It sounds dramatic, but the mechanics are so simple it's almost boring. The wealthy buy assets that appreciate. real estate, stocks, private businesses, collections with scarce supply, not cars, not consumer toys, not things that rust, break, or lose value the moment you touch them. Assets that pay dividends, assets that rise with inflation, assets that compound. People think the wealthy get rich from their salaries. Nonsense. They get rich because they buy things that grow faster than they can spend. And here's the key. They don't sell them. Selling triggers taxes, holding triggers compounding. It amazes me how many people never grasp that distinction. At some point, these assets rise in value. A $500,000 property becomes $1 million. A $2 million stock portfolio becomes $5 million. A business grows tenfold. A regular person would sell to access the cash. Then they'd pay capital gains taxes. Then they'd reinvest whatever is left. The wealthy don't do that. They simply borrow against their assets. Why? Because borrowed money is not taxable. A loan isn't income. It doesn't get reported as profit. The IRS doesn't take a cut. You pledge the appreciating asset as collateral. Take out a loan with low interest, sometimes incredibly low, and you get spending money without selling anything. The asset keeps compounding. The taxes remain deferred, and you enjoy liquidity without dilution. This is not a loophole. This is not sleight of hand. This is how asset-backed lending works. Banks love it. Borrowers love it. The IRS has nothing to say because the law is crystal clear. This is the part that really irritates people who never read tax laws. When a wealthy person dies, their heirs inherit the assets at the stepped-up basis. That means the taxable value resets to the market value on the day of death. If someone bought a property for $200,000 and it's worth $2 million when they die, their heirs inherit it as though they bought it for $2 million. If the heirs sell the property immediately, the taxable gain is zero. All the appreciation that occurred during the original owner's lifetime simply disappears from the tax system legally. Billions of dollars can vanish this way every generation. Not because of trickery, because the law explicitly allows it. Now, let me say something harsh. Most people hate this system because they think it's rigged. That's the lazy interpretation. The accurate interpretation is that wealthy people simply read the rules and structured their behavior around them. Anyone can do this at some scale. You don't need billions. A rental property can be borrowed against. A brokerage account can be borrowed against. A business can be borrowed against. The principle is scalable. The discipline is rare. People say, but Charlie, isn't this risky? Everything in life is risky. But failing to understand the tax code is riskier than any loan. The danger isn't borrowing. The danger is borrowing stupidly. The wealthy borrow intelligently, conservatively, with collateral that grows faster than the interest owed. Most people borrow emotionally for things that rot and depreciate. There's a difference. Let me leave you with one final thought. People love to argue about fairness, but fairness doesn't make you rich. Understanding the rules and applying them pragmatically does. Buy, borrow, die isn't a trick. It's a framework, one built on patience, discipline, and respect for the power of untaxed growth. Now, let me tell you something that might surprise you. Warren and I don't resent paying taxes. We believe we should pay taxes. We've said publicly that people like us should probably pay more. Warren has written letters to Congress asking them to raise taxes on the wealthy. He's pointed out the absurdity of him paying a lower rate than his secretary, not because he's trying to score political points, because he genuinely believes those with the most should contribute the most. Bill Gates has said the same thing. He's called for higher taxes on the wealthy, and then he's given away most of his fortune anyway, because he believes the money can do more good in the world than sitting in his bank account. Elon Musk paid $11 billion in taxes in a single year, more than any American in history. When critics said he wasn't paying his fair share, he simply posted the receipts. Here's the point. The wealthy don't hate taxes. They hate inefficiency. They hate waste. They hate paying more than the law requires out of sheer ignorance. There's a profound difference between tax optimization and tax evasion. Optimization is using the law as written. Evasion is breaking the law. The first is smart, the second is criminal. Let me be clear about something. Taxes built the roads we drive on, the schools that educated our workforce, the courts that enforce our contracts, the military that protects our assets, the research institutions that created the technology we profit from. Nobody gets wealthy in a vacuum. Every fortune is built on infrastructure that was funded by taxes paid by previous generations. Orrin and I have been the beneficiaries of this system our entire lives. We built our fortunes in America using American infrastructure, American legal systems, American capital markets. We owe something back. The question isn't whether to pay taxes. The question is how to pay them intelligently while still contributing your fair share. Everything I told you today is written in tax code that's available to anyone. The primary residence exclusion, the Roth IRA, depreciation, business deductions, the stepped-up basis. None of this is secret. None of this is illegal. None of this requires being wealthy first. It requires being informed. It requires planning ahead. It requires treating your financial life with the same seriousness that wealthy people treat theirs. But it also requires understanding why these rules exist. The government gives you tax breaks for building housing because society needs housing. They give you breaks for starting businesses because businesses create jobs. They give you breaks for saving for retirement because they don't want you dependent on Social Security. The tax code isn't random. It's a system of incentives designed to encourage behaviors that benefit everyone. When you take advantage of these incentives, you're not cheating the system. You're participating in it exactly as designed. Learn the rules. Apply them wisely. Pay your fair share. And you'll understand why wealth concentrates in the hands of the few who do the obvious things consistently. Because in my experience, the obvious things done consistently are the most powerful things of all. Taxes are not the enemy. Ignorance is. And if you eliminate ignorance, even a little, you'll be shocked at how much money stays in your pocket.